We've just published the March edition of FX Talking. It's called The Dollar Bear Trend Takes a Rain Check. We're pushing back the period when we expect the dollar to start broadly weakening again. We had expected that in Q2, but it now seems that it's going to be Q3 or later. Now, the reason for the delay in the dollar decline really rests at the Fed and what's going on in the United States economy. We've heard most recently from the Fed Chair Jerome Powell that the Fed might need to take interest rates even higher, 75 to 100 basis points higher into the summer. And in the FX markets, we always look at something called the US yield curve. That's the difference between rates at the long end of the yield curve versus the short end. That's now the most inverted since the early 1980s in America, and typically that environment is pretty positive for the dollar. As you can see in the chart, the dollar typically is quite strong when the US yield curve is very inverted, and that's really key to our dollar story this year. Well, at the same time that the Fed is being very hawkish, so is the ECB. It looks like the ECB is going to do a minimum of another 100 basis points of tightening into the summer again. And just another few words on one of the best performing currencies in the world this year, which is the Mexican peso. On a risk-adjusted basis, the Mexican peso offers some of the most attractive yields in the world. The second factor really looks at supply chain challenges, the concept of nearshoring. We've just heard that Tesla plans to build its next gigafactory in Mexico, which could potentially bring in more than $10 billion. To summarize, we think the dollar will be stronger for longer, and I think we're going to have to look at a lot of local stories as well, of which Mexico is certainly one.